Imagine waking up, checking the news, and bam, the Dow's down 800 points. That's the kind of scenario our sources drop us into today. And it features this iconic figure known for being, well, incredibly calm in market storms.
Yeah, absolutely. Today we're really digging into market volatility, long-term investing, and the, let's face it, pretty unique world of Berkshire Hathaway.
Right.
And our main source is a really in-depth interview with the man himself, Warren Buffett. It came out right after his 55th annual shareholder letter.
Okay, so our mission here, for you listening, is to pull out the really key nuggets from this conversation. Think of it as a shortcut to thinking like, well, one of the greats.
Exactly. We'll unpack his takes on market panics, his interesting business structures, and what it all means, really.
Yeah, what it means for your approach. Let's get into it. So the source material just throws us right in. Dow down 800 points, coronavirus fears swirling. How did Buffett react?
Well, it's almost disappointingly simple, right? He just says he likes to buy stocks when they're cheaper.
Curate, just like that. But it's more than just being calm, isn't it? It's like his core thing.
It absolutely is. It's not just some off-the-cuff remark. It is his philosophy.
Yeah.
He keeps hammering this point. Buy a piece of a business, not just a stock ticker.
Right.
The question isn't the last day or two. It's what's the outlook for American business over 10, 20, 30 years? Volatility for him? Well, that just means things are on sale.
Okay, but, for most people, watching your 401k shrink doesn't exactly feel like a shopping opportunity. How do you get that mindset?
He uses these great analogies like buying a farm or an apartment building. You wouldn't sell your farm because of a bad weather report for next week, right?
No, of course not.
The daily price swings, they don't matter for the long-term value. And he tells that story about his first stock purchase, March 12th, 1941. Market was down 2%.
Wow.
And the General Motors story from 1932. Amazing. They had like 19,000 dealers, more than today, and sold less than one car per dealer per month. Crazy low.
Unbelievable.
Yet, he says, a terrific time to buy GM. It really forces you to look past the immediate noise.
So if even Buffett says he can't time the market, not in 10 minutes, 10 days, 10 months, what are we supposed to do? Just ignore the news?
Well, not ignore it completely, perhaps, but the implication is focus on making an intelligent purchase at a given price.
Yeah.
That's his phrase.
Okay.
Like if you're buying GM with, 1.4 billion shares,
Yeah.
think about buying the whole company for $42 billion, whatever it is, and then crucially write down why. Why this business?
The why.
Yeah, the daily ups and downs, irrelevant to that core decision. It's all about the business value, its future.
This idea, stocks as businesses, the long view, it really clicks with that historical bit he mentioned from Edgar Lawrence Smith's 1924 book.
Oh, yeah, that's a fantastic point. Smith's book. It actually set out to prove one thing about stocks versus bonds in different economic times, but found the opposite.
Really? What did it find?
It found that stocks, even with the same starting yield as bonds, tended to outperform over time. Why? Because of retained earnings.
Retained earnings, the money companies keep.
Exactly. Money they reinvest back into the business, building future earning power. It's like this hidden growth engine. And, people totally forgot about this simple idea in the run-up to the 1929 crash.
That forgotten insight feels so relevant now, especially with this TINA concept, there is no alternative.
Right, TINA. The idea that you have to buy stocks because bonds yield practically nothing.
I mean, a 30-year bond at 2%, you said that's like paying 50 times earnings for something where the income can't grow? For 30 years.
It makes stocks look, well, comparatively cheap. Buffett lays out the options: short-term cash, long-term bonds, or long-term stocks. And right now, he's clear, stocks are cheaper than bonds.
Which kind of brings us to this bizarre global situation. What is it? $13 trillion in negative interest rate debt.
Yeah, it's mind-boggling. He notes that, brilliant economists just didn't see this coming.
How does that even work? And what does it do to, say, banks?
Well, interestingly, U.S. banks have actually done okay, made decent money even with low rates. But you look at the U.K., Europe, Japan, rates are even lower there, sometimes negative. And that makes it, as he puts it, pretty tough for banks. Really squeezes their profitability.
And insurance companies, especially those selling annuities.
Oh, yeah, that's a tough spot.
Yeah.
If they promised, say, 4% or 5% returns years ago, and now they have to reinvest maturing bonds at maybe 1% or 2%, well, you see the problem.
Big problem.
That's why Buffett warns so strongly against reaching for yield, trying to get extra return in this environment by taking on sketchy risk. He calls it stupid but very human.
that human element. And he mentioned how the U.S. government actually benefits from this, right? Makes servicing the national debt cheaper.
Enormously cheaper. We've got, what, $22 trillion in debt? Low rates keep the interest payments manageable. But if rates shot up, ouch, the cost would explode.
It's just such a strange world. Austria is selling 100-year bonds at 2%. Wild.
Totally unprecedented, really.
Okay, let's shift from the macro view to inside Berkshire itself. He's always fighting this idea that it's just a big clunky conglomerate, right? That conglomerate discount.
He is, and he pushes back hard. He draws a line between Berkshire and those abusive conglomerates from the 60s that were all about financial games.
Playing with the numbers.
Yeah, kind of like chain letter arrangements, he says. Berkshire, he argues, is built for business reasons. And his killer comparison, an index fund.
An index fund? How so?
Well, think about it. An S&P 500 index fund, that's the ultimate conglomerate, right? You're buying 500 different businesses all bundled together.
That's a good point. So why the discount perception then? What's his argument against it?
He thinks it's mostly based on old, outdated ideas. The real magic, he says, is Berkshire's decentralized structure. The managers running the subsidiaries, they have incredible freedom.
Like the See's Candies example, he hasn't been to a factory in 10 years.
Exactly. Or BNSF Railway, spending billions on capital projects without needing his direct shop. Okay, it frees them up.
Frees them from what?
From Wall Street pressure. They don't have to worry about hitting quarterly numbers to please analysts. They can just focus on running the business well for the long term.
And that decentralized model must have advantages for moving money around too.
Huge advantages. Tax-efficient capital allocation is key. Berkshire can take billions in cash generated by, say, See's Candies and deploy it into another Berkshire business that needs capital, all without triggering immediate corporate taxes on that movement.
Ah, okay. And the managers just focus on their business.
Right. No roadshows, no schmoozing analysts. Just run your company.
Speaking of those companies, let's look at some portfolio highlights. Geico, for instance. Huge growth under Berkshire.
Massive growth. Went from like 2.5% market share to nearly 14%. The big focus now, he says, is on correlated risk with rate.
Correlated risk with rate, meaning what exactly?
Basically making sure the price you pay for insurance accurately reflects all the risks, including things that might affect lots of policyholders at once, like, say, hurricane season in Florida, or maybe even economic factors that change driving behavior. It's complex.
Okay.
That's apparently why Todd Combs, one of the top investment managers, stepped in as interim CEO there to really get the pricing right.
Interesting. And then the banks selling down Wells Fargo, but liking Bank of America.
Yeah, the Wells Fargo thing was partly regulatory, staying under 10% ownership, but also he clearly wasn't happy with how they handled that whole fake accounts theft.
Scandal.
It ties back to Charlie Munger saying, an ounce of prevention is worth a ton of cure. They felt Wells Fargo didn't prevent the problem well enough.
And Bank of America.
The B of A buys back its stock aggressively. So Berkshire's ownership percentage goes up automatically without them spending another dime. Pretty neat.
Smart. And Apple. He calls it their third largest business.
Which is incredible, right? And he stresses it's a consumer products company in his eyes, not a tech stock. He loves the brand loyalty, the ecosystem.
And he finally got an iPhone.
He did, after all those years with a flip phone. Quite the endorsement.
What about Kraft Heinz? That one sounds a bit more troubled.
Yeah, he's candid about that. Still a very valuable business, he says, but admits they paid too much and it carries too much debt. He talks about this ongoing battle between big brands, like Heinz Ketchup, still super strong, and private labels like Costco's Kirkland brand, which has become a powerhouse.
So some brands hold up, others don't.
Seems like it. He points out it's almost impossible to create a new brand with the power of something like Coca-Cola today. The moves are just too wide.
And the newspapers, selling those off.
A pragmatic move. He basically said most newspapers were toast because print circulation just collapsed. The big national papers, the Times, the Journal, the Post, they saw it coming earlier, he admits.
Okay, and we have to ask about the cash. Over $125 billion. What's the plan?
Preparedness. Plain and simple. He wants Berkshire ready for anything. Pandemics, markets freezing up. He wants to know they can meet every single obligation no matter what. It's like ultimate financial security.
Makes sense. And share buybacks. Is that a way to use some cash?
They're eager to do it, he says, but only at the right price. He even put instructions in the letter for how big holders could sell shares directly to Berkshire.
Why do that?
Because Berkshire stock is held by so many long-term investors, it's hard for them to buy back large amounts in the open market without pushing the price up too much. It's different from companies with more trader types holding their shares.
Got it. And quickly, succession, board stuff.
He stresses they're well prepared. Ajit Jain and Greg Abel are clearly taking on more visible roles. And his criteria for directors: simple, integrity, business smarts, and a real stake in Berkshire.
He doesn't seem too keen on the idea of independent directors just for show.
No, he's skeptical. He wonders how independent you really are if you're getting paid, say, $300,000 a year for the board seat.
Right.
He thinks that paycheck might influence you more than anything else.
Interesting perspective. Let's broaden out again. Buffett's not just about stocks, he thinks about the whole world. How did he see the coronavirus impacting the real economy beyond the market swings?
He gave concrete examples.
Yeah.
Dairy Queen franchises in China, mostly the treat-only stores, saw closures. Or just, like, new customers.
Right. Real-world impact.
Apple, obviously, with supply chains and stores closing in China. And even impacts on businesses you might not expect, like John's Manville Insulation or Shaw Carpets, due to disruptions.
Sounds like complex.
Very. He sticks to his line. The long term for America is generally predictable. It's good. But the short term, especially with something like a virus, totally unpredictable.
And his view on the U.S. economy overall at that time?
He described it as strong but a little softer than maybe 6 months before. Not bad, just maybe not accelerating as fast. He thought tariff uncertainty was a factor there.
Okay. Now, politics. He's a Democrat, but it sounds nuanced.
Very nuanced. He says he isn't card-carrying, and has supported Republicans too. He actually agrees with some of Senator Sanders' goals, like boosting the earned income tax credit.
Really? Why that?
He feels strongly that if someone works 40 hours a week, maybe has kids, they shouldn't be struggling to make ends meet, shouldn't need a second job just to survive. He thinks capitalism leaves some people behind, and things like the EITC can help fix that.
But he doesn't agree with everything.
Oh, definitely not. Ideas like giving employees 20% of company stock. He thinks that fundamentally messes with the market system, which he believes works very, very well overall.
So who would he vote for?
At the time, he said he'd vote for Mike Bloomberg over Sanders in a primary matchup. But importantly, he stressed his vote wouldn't be based on who he thought would be better for the stock market in the short term.
And cryptocurrency. We gotta ask.
Yeah, he doesn't mince words there. Cryptocurrencies, he says, have no value. They don't produce anything. His punchline was pretty funny. He said maybe their only economic contribution is that you can go short suitcases because digital currencies make it easier to move money illegally without actual cash.
Always with the wit. He even joked about creating his own crypto, right?
Yeah, the Warren currency or something. Just poking fun.
And before we wrap up, we have to mention Charlie Munger, his partner.
Absolutely. His 96-year-old partner. Buffett calls him the best 30-second mind in the world. Says Charlie could just cut right to the heart of any problem instantly.
An incredible partnership.
Truly. Buffett says he learns something every time they talk. But even these two, there are things they admit they don't understand.
Like what? What stumps Buffett and Munger?
It's profound, really. They admit they don't fully grasp the long-term outcome of a world with these super low, even negative interest rates, combined with, high growth in some areas, and these massive growing government deficits.
So even they acknowledge we're in uncharted territory.
Completely. They say classical economics just didn't really prepare anyone for this specific combination of factors. It underlines how unusual these times are.
Yeah, it really does. It shows that even the smartest people don't have all the answers.
Which emphasizes the need for that resilience, that focus on fundamentals that Buffett always talks about, because the future is uncertain.
So wrapping this all up for you, the listener, what's the big takeaway? This deep dive really shows that Buffett's method, whether it's handling market chaos or building this massive company, it's all about that unwavering focus on long-term value.
Yeah, the underlying business discipline decisions, it's a powerful way to see things.
And we also learned that even for a legend like him, some huge questions loom. Negative rates, pandemics. The script hasn't been written yet.
Exactly. The unusual conditions are real, and even the experts are still figuring them out.
So here's something to think about. What unusual conditions are you facing right now in your finances, your life? And how might thinking with that Buffett-style 10, 20, or 30-year perspective change how you approach them? Maybe change your next move.
Something to chew on.
Definitely. Think about it. We'll catch you on the next Deep Dive.